This is your Lead Left vodcast for the week of December 5th. I'm Randy Schwimmer. Welcome back. A Lead Left reader and leveraged finance veteran disagreed with our statement last week that private credit terms have never been more investor-friendly. He compared them to more conservative loan structures and legal protections in the 1990s. Since then, private equity has found innovative ways to weaken lender positions, such as moving assets out of borrower entities and diminishing rights acceleration, not to mention the elimination of financial covenants. So, having been at JP Morgan ourselves, when we had a ringside seat on that erosion, we know that the sophistication of broadly syndicated loans over the past 3 decades is at the point where they match high-yield bonds in issuer friendliness. But when we talk about private credit terms, we mean the middle market. For smaller, non-traded loans, term erosion has been less dramatic. Covenant Light, for example, has been limited to larger companies. And sponsors are putting in multiples more of cash equity than the 10 to 20% prevalent back in those days. Loan spreads have widened in the wake of Fed rate hikes. That's different than the 06-07 period when spreads compressed as the benchmark rose. Hard to recall a time when senior loans were commanding 10 to 12% unlevered yields. Private credit has become an institutional asset class only in the last decade. Before that, managers might generate returns higher than bonds or BSLs, but it was tough to do consistently and at the same time scale their platforms. Private capital is not a trade, one private credit pro told us recently. Sure, there's an opportunity today to pick off some nice yields from the bond desks, but next year that trade goes away, and where does that leave you? There's also a unique risk-reward dynamic with privates in a diversified portfolio, he said. Being less correlated has served investors well over the past few years. Private M&A multiples are up relative to public comps. In a higher for longer world, short duration risk is a big assist. Finally, private credit valuations only move with credit deterioration. He said, think of private capital providing BBB returns with BB assets and only single-A losses. Reporting from the AAA division at the Lead Left, this is Randy Schwimmer, wishing you and your families a safe and healthy week.